Something just happened that, on the surface, makes no sense. Yesterday, the Federal Reserve did exactly what every single analyst, every trader, every algorithm on Wall Street predicted they would do. They held rates. No surprise, no twist, no dramatic pivot. Completely expected. And yet, Bitcoin dropped. Not a slow bleed, not a gradual exhale. It pulled back. It wobbled. And today, on April 30th, 2026, it sits around $76,000, down from the 77,000s it was holding just days ago. So here's the question that nobody's really answering right now. If nothing surprised anyone, why did the market react like something broke? Because here's what I'm going to show you in the next 20 minutes. This wasn't about rates. This wasn't even about Bitcoin. This was a signal. A quiet, almost invisible signal that something underneath the surface of this entire financial system just shifted. Stay with me until the 15-minute mark, because what I break down there changes how you see everything that's coming next. Quick note before we go further, nothing in this video is financial advice. This is analysis, education, and my honest read of what's unfolding. Always do your own research. Now, let's get into it. And if you're new to the Wealth Continuum, welcome. Hit subscribe before this video ends. Because what we cover here is the kind of thinking that puts you ahead of the narrative, not behind it. Morning, afternoon, or night where you are right now. Drop it in the comments. I always like to know who's watching and from where. Let's start by dismantling the idea that nothing happened. Markets, at their core, are not moved by events. They're moved by the difference between what was expected and what actually occurred. If the Fed surprises everyone with a rate hike, panic. Markets sell off hard. If the Fed cuts unexpectedly, risk assets explode, crypto pumps, everyone cheers. But when the Fed does exactly what was expected, in theory, nothing moves. That's the textbook version. Here's the real version. The Federal Open Market Committee, the FOMC, voted to hold the benchmark federal funds rate in a range of 3.5 to 3.75%. Third consecutive meeting with no change. Markets had priced in 100% probability of a hold. Completely unanimous expectation from traders. And yet, Bitcoin, which had been hovering comfortably in the upper 77,000s going into the meeting, drifted lower. Risk sentiment softened. The quiet confidence that had been building in the market over the past few weeks cracked. Why? Because this meeting wasn't just about what the Fed did. It was about what the Fed refused to do. And more importantly, it was about what the meeting revealed about the road ahead. And that road is a lot darker and more uncertain than most people want to admit right now. Now here's the part nobody is paying attention to. This wasn't a normal hold. This wasn't a routine, boring, unanimous decision where everyone nodded and went home. This was the most fractured Federal Reserve decision since October 1992. 4 FOMC members dissented. 4. In opposite directions. On one side, you had officials who wanted to cut rates. On the other side, you had 3 Fed presidents, Hammack, Kashkari, and Logan, who refused to even allow language that hinted at future easing. Think about what that means for a second. The people setting the monetary policy for the largest economy in the world cannot agree on which direction to go. That's not stability, that's a standoff. And markets, especially Bitcoin, can smell a standoff. Comment below if you think the Fed has lost control of the narrative. I'm genuinely curious how many of you feel that way right now. Now let's talk about what's actually creating this mess, because this isn't happening in a vacuum. 2 things are colliding at exactly the wrong time, and together they are making the Fed's job almost impossible. The first is energy prices. The US-Israeli conflict with Iran has sent oil prices spiking. And when oil spikes, inflation doesn't just tick up, it bleeds into everything. Transport, manufacturing, food, services. The FOMC's own statement on Wednesday said it plainly. Inflation is elevated, and it is tied in part to the recent increase in global energy prices. Now, the Fed knows this. They know energy shocks are often temporary. They know you don't raise rates to fight a war-driven oil spike. But here's the trap. The longer prices stay elevated, even for temporary reasons, the more they start embedding themselves into consumer expectations. And once expectations shift, inflation becomes structural. It stops being a bump and starts being the floor. That's what Hammack, Kashkari, and Logan are worried about. That's why they refuse to allow even a hint of dovish language in the statement. They are looking at energy prices, looking at core PCE inflation projected at 2.7% by year end, still above the 2% target. And they're saying we are not done yet. The second factor, and this one is the one that matters most for Bitcoin, is the leadership transition at the Federal Reserve. This meeting may have been Jerome Powell's last as Fed chair. His term ends on May 15th. Kevin Warsh, President Trump's nominee to replace him, is waiting in the wings. And while Warsh has publicly said he won't be the president's, quote, puppet, Trump has made no secret of his desire for significantly lower interest rates. Markets are watching this closely. Because here's the thing. The Fed's next move isn't just about data, it's about who is sitting in the chair. And that uncertainty is worth a lot of anxiety right now. But this is where things start to get really interesting and really dangerous for anyone who doesn't understand what's underneath the surface. Hit like if this is starting to make sense. Because what I'm about to get into is the part most analysts skip completely. Here's a truth that a lot of casual investors miss entirely. Bitcoin does not primarily move on news. It doesn't primarily move on adoption. It doesn't even primarily move on fundamentals, at least not in the short to medium term. Bitcoin moves on liquidity, global liquidity, dollar liquidity, the amount of money that is loose, available, and looking for risk. When liquidity expands, when central banks inject, when rates fall, when money becomes easy, it has to go somewhere, and some of it finds its way into Bitcoin. When liquidity tightens, when rates stay high, when dollars become scarce, when money gets expensive, risk assets get squeezed. And Bitcoin, one of the most liquidity-sensitive assets on the planet, feels it first. That's not a theory. That's a pattern that has repeated across multiple cycles. Think about the last few months. Bitcoin had a spectacular run in late 2024 and into October 2025, reaching an all-time high of around $126,000. That run was driven, in large part, by expectations that the Fed would ease aggressively and flood the system with fresh liquidity. By the end of 2025, Bitcoin had given back 30% from that high, because the easing was slower than expected, and the liquidity flood never really came. Fast forward to today, Bitcoin is sitting around $76,000, down roughly $17,000 from where it was trading just a year ago. And the people who are most confused right now are the ones who bought the narrative of a liquidity wave that still hasn't arrived. Now here's what should worry you, and I mean really worry you, about what the Fed just said on Wednesday. Markets are currently pricing in 0 rate cuts for the rest of 2026. 0. Not 1. Not a half cut. 0. And they're pricing in no meaningful movement well into 2027. That means the liquidity that Bitcoin needs, the fuel that powers the next explosive rally, is not coming anytime soon. At least not through the front door. What happens next is the real story, and most people are going to miss it completely. Let me show you the trap. Most retail investors right now are operating on one of 2 beliefs. Belief number 1, the Fed will eventually pivot, rates will come down, liquidity will return, Bitcoin will explode. Just hold on. Belief number 2, the economy is slowing, inflation is stubborn, and this sideways chop is the new normal for a while. So just wait and watch. Both of these beliefs have a problem. The first one is directionally correct, but dangerously early in its timing. People have been calling for the pivot for over a year now. Every Fed meeting, there's a wave of optimism. And every time the Fed says, not yet. The people holding on to this narrative are getting worn down psychologically. And worn down holders make bad decisions at exactly the wrong moment. The second belief is too passive. The people who decide to just wait and watch are the same people who end up chasing price when something finally breaks. They miss the setup because they're waiting for the confirmation. Here's the real danger zone, the period between the narrative breaking and the market responding. Let me explain. Right now, the dominant narrative is rates are stable, the economy is holding, there is no emergency, no crisis, no reason to panic. And that might be true on the surface, but underneath, cracks are forming. The national debt sits at nearly $39 trillion. Servicing that debt at elevated rates is consuming an enormous and growing share of government revenue. Corporate debt, especially among smaller and mid-sized businesses, is being refinanced at rates that are crushing margins. Consumer credit stress is quietly building. High rates don't announce when they've done too much damage. They just keep working silently until something breaks, and when something finally does break, that's when the Fed gets the emergency it needs to act. And here's the historical truth. They don't act slowly when that moment comes. They flood the system. Are you positioned or just watching? Drop your answer in the comments. I want to know how many of you are actually in the game right now versus standing on the sidelines. Back to the original question. Why did Bitcoin specifically react so fast after the Fed announcement? Because Bitcoin is one of the earliest moving liquidity indicators in the entire financial system. It doesn't wait for confirmation. It doesn't wait for a press release or a central bank statement or a quarterly report. It moves on anticipation. When the Fed held, and more importantly, when the language of the statement signaled that no easing is coming for a very long time, Bitcoin repriced almost immediately. Not because Bitcoin is weak, not because the fundamentals changed, because Bitcoin, unlike a stock or a bond, has no earnings report to hide behind. There's no corporate narrative, no guidance, no analyst revision to buffer the reaction. It just responds directly, immediately, honestly. And what it responded to on Wednesday was this. The pivot that traders had been quietly pricing in for months is no longer on the table. Not for now, maybe not for a year or more. But here's the flip side, the part that almost nobody is talking about. The same speed with which Bitcoin drops on tightening signals is the same speed with which it explodes when easing returns. Look at what has happened even in this environment. Despite the macro headwinds, spot Bitcoin ETFs have pulled in over $2 billion in April alone. Institutional money isn't leaving, it's accumulating quietly. Exchange reserves, the amount of Bitcoin sitting on trading platforms available to be sold, are at multi-year lows. When supply contracts and institutional demand hold steady, you have a setup for something violent in the upward direction when the catalyst finally appears. The question is just, what is the catalyst and when? This is where it gets dangerous, because the most powerful catalysts in financial markets don't come announced. They come as surprises, crises, breaking points. And the Fed's silence on Wednesday told us something. They don't think we're there yet. But the market's reaction told us something too. It's getting closer than they want to admit. This is the part that I want you to sit with for a moment, because it sounds counterintuitive, but once you see it, you cannot unsee it. The scenario that would force the Fed to act most aggressively, a genuine financial shock, a credit event, a moment where something visibly breaks, would initially be terrible for Bitcoin. It would drop hard, fear would spike, retail would panic sell. But then, and this is the twist, the Fed's response to that shock would be the single largest bullish catalyst Bitcoin could receive. Because when the Fed floods the system, and historically, they have always flooded the system when the pain becomes unbearable, risk assets don't recover slowly, they rocket. We saw it in March 2020. Catastrophic crash. Fed injects trillions. Bitcoin goes from around $5,000 to $69,000 over the next 18 months. We saw it in the post-2022 rate cycle. The tightening caused maximum pain. Then the easing began, and Bitcoin ran from around 16,000 to over 126,000. The pattern isn't guaranteed to repeat, but the mechanics, cheap money-chasing risk assets, are as reliable as gravity. So the drop you're seeing right now, it might not be the beginning of a collapse. It might be the last phase of compression before the next expansion. The question is whether you're positioned to be on the right side of that trade when it comes, or whether you're going to be watching from the outside, wishing you'd paid attention in April of 2026. What would you do if this actually plays out the way history suggests it could? I want to hear your answer. Drop it in the comments below. Let me zoom out now, because I don't want to leave you with just the mechanics. I want to talk about what this moment actually means. We are at an extraordinary intersection in financial history. You have a Federal Reserve that is genuinely split. 4 dissenters, the most division in over 3 decades, trying to navigate a war-driven inflation spike, a $39 trillion debt load, and a political environment where the president is openly pushing for lower rates. You have a leadership transition at the most powerful central bank in the world happening in the middle of this. Powell stepping back, Kevin Warsh stepping in. Markets will spend months trying to figure out what that means for policy. You have Bitcoin, this strange, stateless digital asset, sitting at $76,000, roughly 40% below its all-time high, held up by institutional accumulation and ETF inflows, even while retail sentiment has cooled significantly. And you have a global macro environment where energy prices, geopolitical risk, and trade tensions are creating a level of uncertainty that hasn't been seen in years. This isn't normal market noise. This is a structural inflection point. And here's what I've learned about inflection points. The people who recognize them while they're forming, not after, but while, are the ones who end up on the right side of history, financially and intellectually. The people who wait for certainty, who wait for the pivot to be confirmed, who wait for the headline that says liquidity is back. Those are the people buying the top of the next move. Do you think the system can hold at these rates for another year and a half? Honestly, do you? Because the data is starting to suggest the answer is getting more complicated. Share this video with someone who needs to understand what's happening before it's too late. Not because I'm trying to alarm anyone, but because this conversation is one most people in your circle probably aren't having. So where does this go from here? I'll give you 2 honest scenarios. Not hopium, not fear. Just the 2 most likely paths based on what we know right now. Path 1, the slow grind. Rates stay where they are. Warsh comes in, proves to be more independent than expected, keeps the tightening bias, energy prices stabilize. Inflation stays sticky, but doesn't spike further. The economy wobbles, but doesn't break. In this scenario, Bitcoin stays range-bound, somewhere between 60,000 and 85,000 for the next 6 to 12 months, grinding, frustrating, testing the patience of everyone holding. But, and this matters, the accumulation continues. ETFs keep buying. Corporations keep adding to balance sheets. Exchange reserves keep falling. The setup gets tighter and tighter until something finally triggers the release. Path 2, the crack. Some part of the debt market or the corporate credit stack or geopolitical escalation causes a visible stress event. Markets drop hard across the board. Bitcoin dips sharply, possibly back into the 60,000s or lower. But then the Fed has its emergency, and it acts fast, hard, with everything it has. In this scenario, the recovery in Bitcoin is not gradual, it's violent. It's the kind of move that creates the stories people tell for years. The honest take? Both paths ultimately lead to the same destination. More liquidity, eventually. The only question is how much pain comes first, and whether you're positioned for the outcome or just hoping things work out. Let me bring this all the way back to where we started. The Fed held rates. Everyone expected it. Nothing should have moved. But Bitcoin moved because Bitcoin isn't reacting to the decision. It's reacting to the message inside the decision. And the message, buried in the dissents, in the inflation language, in the absence of any dovish signal, was this. The system is under pressure. We are not ready to relieve it. Not yet. That "not yet" is the most important phrase in finance right now, because it means the pressure keeps building, and pressure that builds long enough always, eventually, finds a release. What we're watching right now is the compression phase, and if history is any guide at all, compression phases are not when you run away from Bitcoin. They're when you pay the most attention. They're when you do the work while everyone else is distracted by noise. So let me ask you one final question before you close this video. Are you going to be the person who looks back on April of 2026 and says, "I saw it, I understood it, I was ready," or the person who says, "I heard about it, I just didn't act on it. The information is right here. What you do with it is entirely up to you"? If you've been watching the Wealth Continuum for a while and this video finally made the bigger picture click, do me a favor and drop the word "signal" in the comments. I'm tracking which topics are resonating most deeply, and that one word tells me everything I need to know to keep going deeper. And speaking of going deeper, what do you want me to break down next? Drop your suggestion in the comments. The next video is going to be shaped by what this audience actually wants to understand. That's how this channel works. You drive the content. If this breakdown gave you something real to think about, hit like. It takes 1 second and it means everything for getting this analysis in front of the people who need it. Subscribe if you want to stay ahead of what's coming, not behind it, not reacting to it, ahead of it. And share this with someone in your life who's trying to figure out what is actually going on in this economy right now. Because that conversation, it needs to happen. I'll see you in the next one.